There has been a noticeable shift in how people are talking about gold and silver lately. Not long ago, confidence was high, prices were rising, sentiment was strong, and many felt certain about the direction ahead. But when markets suddenly move the other way, emotions tend to change just as quickly. What felt obvious before can start to feel uncertain, and that shift can create confusion. Moments like this are not unusual. Financial markets have always moved in cycles, and those cycles are often driven as much by human behavior as by actual data. When prices rise steadily, confidence grows. When prices fall sharply, doubt takes over. That emotional swing can sometimes make short-term movements feel more significant than they really are. What is important right now is to slow down and look at the broader picture. A sudden decline does not automatically mean that a long-term trend has ended. It can mean many things. Sometimes it reflects temporary pressure, sometimes it signals a deeper change, and sometimes it is simply part of a normal correction after a strong move. Recently, gold has pulled back from higher levels, while silver has experienced even more noticeable volatility. At the same time, energy prices have moved upward, creating additional pressure across global markets. These developments have influenced expectations around inflation and interest rates, which are key factors in how precious metals are priced. When energy costs rise quickly, it can affect nearly every part of the economy. It can increase transportation costs, raise production expenses, and influence how central banks respond to inflation. This creates a complex environment where different forces are pushing in different directions at the same time. Some people expect gold to rise immediately whenever uncertainty increases. While that can happen, it is not always immediate or straightforward. In periods of stress, investors often seek liquidity first. This means they may sell assets not because they want to, but because they need to manage risk or meet financial obligations. During such times, even strong assets can experience short-term declines. This does not necessarily mean those assets have lost their long-term value. It simply reflects the reality that markets are influenced by multiple factors at once. Gold, for example, is affected not only by fear or uncertainty, but also by interest rates, currency strength, and overall liquidity conditions. When interest rates remain relatively high, it can create competition for gold. Investors may find returns in other areas, which can reduce immediate demand for metals. At the same time, if inflation remains a concern, that can support the longer-term case for holding assets like gold. Silver adds another layer of complexity. It is not only considered a store of value, but also an industrial metal. This means its price can be influenced by economic growth expectations. If there are concerns about slowing economic activity, that can weigh on silver in the short term, even if its long-term supply and demand balance remains tight. Current data suggests that global demand for silver continues to be strong, while supply growth has not fully caught up. This creates a situation where the market may remain structurally tight over time. However, short-term price movements can still be volatile, especially when broader economic conditions are uncertain. It is also important to understand that markets rarely move in straight lines. Even in strong long-term trends, there are periods of consolidation, correction, and uncertainty. These phases can test confidence and create doubt, but they are often part of the overall process. One of the biggest challenges for investors during times like this is separating short-term noise from long-term signals. Price movements can be influenced by temporary factors, while underlying trends may remain unchanged. Recognizing the difference requires patience and a clear framework. There are multiple factors currently influencing the direction of precious metals. These include global economic conditions, central bank policies, inflation expectations, and geopolitical developments. Each of these factors can shift over time, creating a dynamic and sometimes unpredictable environment. Central banks, for example, play a significant role in shaping market expectations. When they maintain tighter policies, it can put pressure on assets like gold in the short term. However, over the longer term, broader economic conditions and structural trends often have a stronger influence. Another important factor is the level of global debt. As debt levels remain elevated, it creates long-term questions about financial stability and policy flexibility. These concerns can support interest in assets that are seen as stores of value, especially during periods of uncertainty. At the same time, market sentiment can change quickly. When prices are rising, optimism grows. When prices fall, that optimism can turn into caution or even fear. This emotional cycle is a natural part of market behavior, but it can also lead to overreactions in both directions. Understanding this cycle can help provide perspective. A sharp decline may feel significant in the moment, but it does not always reflect a fundamental change. Similarly, a strong rally does not guarantee continued gains. Markets are constantly adjusting to new information and changing expectations. It is also worth noting that different types of investors participate in these markets. Some focus on short-term opportunities, while others take a longer-term view. Institutional investors, central banks, and individual participants all have different goals and time horizons. This diversity of perspectives contributes to market complexity. When multiple forces interact at once, price movements can appear confusing. For example, rising energy costs may increase inflation concerns, while at the same time slowing economic growth. This creates a situation where traditional relationships between assets may not always behave as expected. In such environments, it becomes even more important to remain disciplined. Emotional decisions can lead to unnecessary risk, especially during periods of heightened volatility. Maintaining a balanced approach and focusing on long-term objectives can help navigate these challenges. Another key consideration is that market conditions can change gradually rather than suddenly. What appears to be a sharp shift may actually be part of a longer transition. These transitions can involve periods of uncertainty as the market adjusts to new realities. For gold, the long-term drivers remain tied to factors such as inflation, currency stability, and global economic confidence. For silver, the combination of industrial demand and investment interest creates a unique dynamic that can lead to more pronounced price swings. Neither of these markets exists in isolation. They are part of a broader financial system where changes in one area can influence others. Understanding these connections can provide a more complete picture of what is happening. It is also helpful to consider the role of expectations. Markets often move based on what participants anticipate rather than what is currently happening. When expectations change, prices can adjust quickly, even if underlying conditions have not fully shifted. This is why it is important to avoid drawing conclusions based solely on short-term movements. A single week or even a single month does not define a long-term trend. Looking at a wider time frame can provide more clarity and reduce the impact of temporary fluctuations. At the same time, it is important to acknowledge uncertainty. No market outcome is guaranteed, and conditions can evolve in unexpected ways. Being aware of potential risks and remaining flexible can help manage this uncertainty effectively. For those observing the market, this period can be seen as a test of perspective. It is a time to evaluate not only the data, but also one's own approach to decision-making. Staying calm and avoiding impulsive reactions can make a significant difference over time. There is also value in understanding that discomfort is a natural part of investing. Periods of volatility can feel challenging, but they are often where important adjustments take place. These moments can provide opportunities for reflection and learning. At the same time, it is important not to assume that every decline represents an opportunity. Careful analysis and thoughtful consideration are essential. Each situation is unique, and decisions should be based on a clear understanding of the factors involved. Maintaining a long-term perspective can help reduce the impact of short-term noise. While markets may fluctuate, underlying trends often develop over extended periods. Keeping this in mind can provide a sense of stability during uncertain times. It is also useful to remember that markets are influenced by both data and behavior. Economic indicators, policy decisions, and global events all play a role. At the same time, human psychology can amplify movements, creating periods of overreaction. Balancing these elements requires patience and discipline. It involves recognizing that not every movement requires immediate action. Sometimes, the most effective approach is to observe, analyze, and wait for clearer signals. In the current environment, there are both challenges and opportunities. Rising costs, shifting policies, and changing expectations all contribute to a complex landscape. Navigating this landscape requires a thoughtful and measured approach. Ultimately, the focus should remain on understanding the broader context. Short-term fluctuations are part of the process, but they do not necessarily define the future. By maintaining a clear perspective, it becomes easier to make informed decisions. As conditions continue to evolve, staying informed and adaptable will be important. Markets will continue to respond to new developments, and those responses may not always be predictable. However, a consistent and disciplined approach can help manage uncertainty. This period serves as a reminder that markets are dynamic and ever-changing. While it is natural to feel uncertain during times of volatility, it is also an opportunity to reinforce a balanced and thoughtful approach. In the end, clarity often comes not from reacting quickly, but from understanding deeply. Taking the time to evaluate the situation, consider different perspectives, and remain patient can make a meaningful difference over the long term. This discussion is intended for general understanding and educational purposes. It reflects a broad view of current market conditions without making specific predictions or recommendations. Each individual's situation is different, and decisions should be made based on personal goals, risk tolerance, and careful consideration.